Well, we will begin with an address by Mr. Shamil Majumdar, Editor, Business Standard. Can I request him to please come on stage?
Good evening, ladies and gentlemen. Once again, a very warm welcome to all of you to the Business Standard Annual Banking Forum, the biggest such platform where the thought leaders of India's financial services sector get together to share their thoughts on some of the most pressing issues facing the Indian economy. We are grateful to each one of the panel members for taking time off their busy schedule and be with us to make today's function a success. A special thanks to Mr. N.S. Vishwanathan, Deputy Governor RBI, for agreeing to come for today's function and give his address. He will keenly await his address, which will follow after this. Perhaps the theme of today's forum, the great Indian banking conundrum, is perhaps most appropriate in today's day and times. India's fragile financial system brings both despair as well as hope. Hope because if you see the latest RBI data, the credit flow to the system is growing at a decent pace. And what is most interesting is even bank lending to NBFCs are going at, I was told, about 37%. Now the best part of it is the market seems to have started differentiating between the good NBFCs and the bad NBFCs, which is perhaps the right way to go. Now, as things were settling down, obviously there's a lot of ground to cover. As things were settling down, suddenly the PMC, the controversy or problems surrounding the PMC Bank came as a stark reminder that the banking system cleanup in India still has significant work to be done, not just in terms of credit quality selection, but also structural corporate governance. Now, we all hope the situation improves, as until the NPA crisis hit us, banks contributed more than 90% of the economy's commercial credit. As a result, any impairment of banking has a deep and long-lasting impact on the economy. Data from corporate balance sheets suggest that year-on-year growth in borrowing from bank and non-bank sources has witnessed a secular decline since at least 2011-12. There was a recent Fitch Ratings report which says that if the sluggish pace of lending continues, is maintained throughout the year, then total new lending will amount to only 6.6% of GDP in 2019-20, down from 9.5% in the previous fiscal. Now, that's not a very happy place to be in. The problem is that the governance reforms proposed by the PJ Nayak committee, which could have allowed the healthier banks to lend more freely, have, for some strange reasons, been put on the back burner. But having said that, while the focus is all on public sector banks, the fact of the matter is some of the private sector banks also haven't really covered themselves in glory. The gross NPA, gross advances ratio in some of the PSU banks is not much higher really than some of the leading names in the private space. In fact, private and foreign banks were very much part of the consortia that are now exposed to some of the largest NPAs. I am sure the discussions today will shed light on some of these issues and more. Today's discussions are being moderated by Mr. Tamal Bandyopadhyay, my colleague. I would now request Mr. Vishwanathan to come and give his address. So, Mr. Vishwanathan, it's your turn now.
Good evening, everybody. Mr. Tamal Bandyopadhyay, Mr. Shamil Majumdar, delegates, panelists, some who spoke already, some are going to speak later. I must say that the subject topics that have been put together covers a large number of issues or very important issues that in the financial system that we are grappling with. And I had the benefit of hearing the last part of the previous panel, and I thought the issues that were being discussed were very interesting. Comments came were very interesting. And I'm sure that the following panels are going to be as interesting, if not more. But when I'm speaking as a regulator, and I have been in this for a while now, the important thing that concerns me or concerns RBI when it comes to how financial intermediation sector in general, banks in particular, handle their business is the whole issue of risk management. I think technically or generally, if banks get their risk management right, then most of the problems are not likely to be there. I must say that the whole business of financial intermediation involves assuming risks and generating risk-adjusted income. So in this business, income is fundamentally generated from four sources, which are they? Number one, leveraging the arbitrage in term structure and interest rates by appropriately transforming the maturity and denomination profile of the liabilities into maturity and denomination profile of assets. So on the one hand, short-term into long-term, smaller deposits getting aggregated and being lent in large numbers. Second, by appropriately pricing the risk to ensure that the returns are more than the expected losses. Third, by exploiting the changes in market prices of various financial instruments. And lastly, of course, by offering various financial services for a fee. When entities pursue these activities, considering the unique characteristics of financial intermediation, in the interest of the entity, the depositor, and the public interest at large, given that the financial intermediation space is relatively leverage much higher, and in the case of banks, I used to always say they have access to large quantum of uncollateralized funds from the public sector in the form of deposits. Given that the governance required in a bank and in a financial intermediary are of an extremely higher order and of a different kind as opposed to what you would require elsewhere. Now, the second part is that while the banks have expected losses, they also have unexpected losses. And the unexpected losses are expected to be covered through capital. So the principle is that the regulatory capital is supposed to address unexpected losses, and the provisions that are made are for incurred losses. Of course, in the framework, we also have a provision for expected credit loss in the form of what is general provision made for standard assets. So it is expected that the unexpected loss in the portfolio is generally expected to be at the level of the standard asset provisions that one makes. And which means that elsewhere, when the provisions required are going to be much more, then it is beyond the unexpected losses that one plans for. And when that provisioning requirement results in an erosion of capital to the extent that the entity is not able to bear that loss, then it means that the risk management framework in that entity is not in order. Number one, the risk governance is not able to ensure that the operations of the bank or the entity concerned is within the risk appetite. And third, it's possible that the risk appetite itself has been fixed at a level beyond the ability of the entity to bear the loss. And now, what I want to get into an interesting point that I have been pondering when I want to come over here. One of the reasons I believe for risk management to be not as strong as it should be would be when there is a possibility of delaying the recognition of loss. So what happens is essentially the losses that arise on account of, say, credit loss when it occurs, or a loss on account of a fraud, or on a loss on account of the duration of the investment portfolio being not in line and therefore an interest rate change impacts the bank adversely. All these, the moment those are recognized, accounted immediately, then the management, the governance structure will find out why is this that we are incurring more loss than we should have. But when there is an opportunity, when there is an proclivity or, to delay that, defer that, do it over a number of terms, then everybody believes that, one, the operations are within the risk framework, or two, as I said upfront, that the risk framework itself is beyond the capability or beyond the risk appetite of that entity. And therefore, at the center of all this is governance. The center of all this is governance in a bank, in a financial services entity. And what does this governance, what should that governance put in place? A risk management framework, a risk appetite framework, and an operational monitoring framework to monitor and ensure that the operations of the entity or bank are being carried out within the framework put in place. So, I have always, in 2016, in a speech that I made on risk management, I referred to the 3 layers of risk governance. So, one, you have what is the business unit, which takes the risks. Then you have the risk monitoring department. And third, you have the internal audit. And I have said that each of these 3 layers have to play their respective roles. And in that speech, actually, I likened this framework to a football game. And I said that the goalkeeper should not become forward and try to put goal on the other side. You have a problem. So if the audit is lax, that's what it will be equivalent to. Similarly, the half-backs or the backs have to stay where they have to defend. So therefore, it's very, very important that this 3 stages operate at the level that is expected of them, number one. And then in that in the analysis of likeness to the football game, I said, where does the board come? Because you have the business unit, you have the risk management unit, and then you have the audit. But where does the board come? The board is the strategist. It's like the manager, the coach of the team who puts all things in place for all the others to follow. And therefore, if the risk governance, the risk management framework in a financial services entity in general and bank in particular has to be of the levels that is expected, the fountainhead of that framework has to be governance. And I think Shamil referred to the reforms that are required on the governance side, and that is something that we need to work towards. One of the things that we have done on the governance side very recently is the framework that we have put in place for compensation for the whole-time directors, CEOs, the risk assumers, etc. What have we done? We have said 3 things in that. One, there must be a proportion between fixed and variable pay. A part of the variable pay has to be deferred, and the variable pay, both deferred and that is not deferred, has to have a non-cash component. And there is a framework for clawback and malus, depending upon whether the risk taken have materialized and resulted in a loss to the bank. I mean, if you ask me in a very nutshell, that huge document essentially speaks this much. And what does it do? It underscores the importance of managing the risks in an effective manner, relating risks to the remuneration, and also underscoring the fact that it will take time for the risks that are assumed to actually manifest. But I am saying that all this should be backed by, or should be kind of added with the board being very concerned about risk governance. And therefore, what I would say is the whole effort at the governance level, whether it is board, executive management, the middle management, should be not to defer recognition of losses, but to identify losses and recognize them on books. So let's see what are the things that happen in a place. Many a time there is delay in recognition of credit loss. there is many a time a delay in recognition of NPAs. So we had to do the AQR, and that resulted in the kind of additional NPAs that were identified. Similarly, there is sometimes delay, not sometimes, many a time, there is delay in recognition of fraud. There is post-recognition, there is delay in reporting fraud. And what does it mean? It only means that we are delaying the recognition of loss. And wherever we are delaying the recognition of loss, it gives the signal to the business unit that risk governance is weak. It enables the business unit to take risks beyond what should be taken by the business unit. Similarly, what happens when there is an interest rate increase in the interest rate, the loss in the capital value of investments, very many times there are requests for that to be deferred, made in installments. But when there are treasury profits, they are taken immediately. So then, what had the RBI to do? Then RBI, when it allowed some of these deferments, we, from our side, regulatorily prescribed an investment reserve requirement. Because the point we are saying is, so while the governance structure should do some of these things, it is becoming also necessary for regulators to prescribe risk management frameworks for the banks. And this is the thing. So I'm urging, because you have CEOs of banks here, large number of you, I would urge upon you to say that the best way to deal with a crisis or a situation is to not to defer the problem. And that is when we are likely to take the right actions at the right time. And many a time what happens is, when things take time or when things are delayed, it only continues to fester in the system rather than delayed. So now, what do we need to do in terms of the governance structure? I was saying that is that the board and the risk management committees has to be very, very strong. So we have said that when you introduce any new product, it must be run through the risk management committee before it goes to the board. We have put in place a mandatory requirement for chief risk officer in banks. We have also made that mandatory for large NBFCs with assets above 5,000 crores. But there are still cases where the conflict between the chief risk officer and the operations, that has to be addressed. So we have to again put in place framework to say what can the chief risk officer do and cannot do. If the chief risk officer himself is into the decision making on credit risk and assuming risk, then how does that conflict get addressed in dealing with credit risk issues or market risk issues in the bank? So again, what I'm saying is, looking at these areas where risk management governance needs improvement, RBI has put in place this. In fact, I understand in some of the countries there are bankers who have worked in other countries sitting here. I understand that the chief risk officers are even cleared by the regulator. Appointment of the person has been cleared by the regulator. We have not gotten into that, but of course, it's expected that the governance structure in the bank is able to deal with that. Now, the information asymmetry. So one of the things that happens is, when will the risk management committee or the board be able to give the right directions if it has the right level of information? So I think it's very important, again, as a management, so you have a lot of chief executives here, sitting here. I think it's important that the kind of information that is provided to the board, to the risk management committee, also enables them to take the right decisions. So I think improve the kind of information that is going to the board or the governance structure to give you the kind of directions that is required to be given. Second, of course, is there is need for ensuring, as I said in the upfront itself, that there must be proper reward for prudent risk-taking. As I said, banking or financial intermediation is in the business of taking risk, but pricing it correctly so that on a risk-adjusted basis, you make an income. And two, you ensure that the operations of the bank are conducted within the risk appetite, and the risk appetite is framed consistent with the risk capability of the bank. And this requires, as I said, proper reward for prudent risk-taking. And as I said earlier, the entire framework on compensation that we have put together is working in that direction. The next issue that is very close to this is how much importance is given to compliance by the bank or by the financial institution. I think the compliance function has to be very, very strong. It must be as strong as the risk governance, risk management function in terms of taking the bank on the straight and narrow path that it is supposed to do within the framework that the board has put in place. So again, this is one area where a lot of work needs to be done in banks in general and maybe in a few banks. And I think as CEOs, you must look at what kind of compliance culture has the organization put in place. And I want to always make a distinction between a compliance function that is tick box and a compliance function that really looks at it from a substantive point of view. Very many times, tick box compliance culture is likely to befool us and keep us believing that we are complying, but while at the underlying, maybe there are issues. And then, which would again mean that the audit committee, for instance, in a bank, should play a very effective role in looking at what does the internal control do to look at the compliance culture. What kind of data and information the inspection system or whatever you call it, internal audit does to provide the feedback to the governance structure on the compliance culture in the bank. And in fact, when we do the supervision of a bank, it ends in a set of action points for the bank to take forward. And it's very important that the management, the whole management, including the board, works very assiduously in implementing them in letter and spirit. So I think, of course, the compliance that a bank has to do does not conform to what the inspection report requires you to. Those are from the RBI perspective. But as an organization, there are several areas of compliance that we need to monitor. And it's very important that the structure that you have put in place, the governance structure that you have put in place to ensure that the compliance is of the same order that is expected is very important. So let me, I think I've almost come to the time that I have been given, so it helps. So I have also, look at some of the governance. For example, in articulating the above, I have taken the liberty of providing a glimpse of the corporate governance guidelines that the Reserve Bank is currently working on. The Basel committee has its own guidelines on corporate governance. We are working on that to improve the guidelines on that. And obviously, we will put them in public domain, seek your comments, and take it forward. Now, a very important element in keeping any entity in general and a bank in particular is the market discipline. And I think for example, in the past, we had a situation where the additional NPAs assessed by the RBI, they were a matter of information between the RBI and the inspected bank. That was not being made public. So the public was guided by the balance sheet as presented by the bank in the public domain, while in effect, as per the RBI's inspection report, the position may be different. So there are very lot of information that, because of the Basel Committee recommendations, disclosures are required. But we need to go beyond that. And the effort should be to disclose more than disclose less, except what you cannot disclose legally. I think that should be the default. Default should be disclose as much as I can, so long as I am not hitting a provision of the law, or I'm not providing a market strategy that is, that's kind of taking the bank forward. As a part of this, for example, we had to, so we have very many unique instructions that RBI has given. One of them is the one that we gave last year, requiring banks to disclose divergence between what they had, what was put in the balance sheet and what is assessed by the RBI in the public domain. And now I think SEBI has, earlier we said that must be disclosed in the annual report, following annual report. Now SEBI has, I think, made it that it must be reported immediately to the stock exchange because they believe that it is a price-sensitive information, and we agree with them. So, to kind of conclude, governance is the thing that banks and financial institutions to look towards. Strengthen governance, not just what has been required by RBI, strengthen governance, recognize losses, look at why the losses are beyond risk appetite, change your operations to conform to the risk governance of the system, improve your compensation system. So what we have put in place is for the key management personnel and the whole-time directors, but see how can it, whoever are risk takers, critical risk takers, how can you align those with them? I think these are important things that you must do. Next, provide as much information to the board and risk governance structure so that they give the right directions. 3, strengthen the compliance function. And as I said, move from a tick box or a checkbox system to substantive compliance. And last but not the least, use the help of market discipline to discipline yourself. Disclose as much as you can, than less. What should be the constraint is law, nothing else. I think this is what I want to say. The 20 minutes that I had, I hope I have kept to my time. Thank you very much.
Thank you so much, sir.